That first 1 lakh rupees sitting in your bank account feels like a milestone, right? A safety net, maybe even enough. What are you going to do with it? Because listen closely, your first 1 lakh rupees isn't just savings, it's potential energy. It holds the power to fundamentally shift your financial trajectory, but only if you invest it wisely. Hi, I'm Vikas Kulkarni, and if you're new here, this channel isn't about get rich quick schemes. We talk about building real wealth strategically and patiently. And in today's video, we tackle that first 1 lakh rupees. I'm going to show you exactly where you should consider putting it after you've built your financial fortress. Now, before we jump into the where, a quick but vital reminder. It only makes sense to invest 1 lakh rupees once your foundations are solid. Because if you're constantly worried, what if something goes wrong, or is this the right time to invest, your mind will always question your decisions. I've spoken about this at length previously on this channel, and here's the video. Basically, you need to have a health insurance, a life insurance if others depend on you, and a solid emergency fund of at least 6 months of your core expense parked in FD or a liquid fund, and clearing any high interest debt like credit cards or personal loan. And with that safety net in place, you invest with confidence and not fear. Okay, now foundation is sorted, so why not just keep that 1 lakh rupees safe in savings or FD, right? Seeing that number feels safe, but is safe really safe? Let's peel back the layers. First, those safe returns are lazy. Right now in India, a savings bank account gives you about 3 to 4% interest annually. And if you create an FD, you might get 6%, perhaps 7% if you lock it away for a couple of years. That seems okay, but compared to what? We're often conditioned to see FDs as the benchmark. It's the default good return. But is that benchmark high enough? And second one is the real danger, and it's inflation. Think of it as a termite silently eating away the value of your money. That 6 to 7% FD return sounds positive. However, if you add up your cost of living, your groceries, your rent, your transport, or that weekend movie date, all these tickets and expenses are rising by 7 to 8% or more per year. And your safe money is actually losing purchasing power. What cost 1 lakh rupees 5 years ago might easily cost 1.4 lakh rupees today. Your FD grew, yes, but slower than the cost of things you need to buy. You're running on a financial treadmill, maybe even slipping backwards while thinking you're moving forward. Investing, particularly in assets linked to economic growth like equities, is your primary weapon to fight this invisible erosion and actually build real wealth. And third, the magic bullet you unlock by investing is compounding. Einstein supposedly called it the eighth wonder of the world, and here's why. It turns small, consistent growth into an unstoppable force. Imagine investing that 1 lakh rupees. Let's use a realistic potential long-term average growth of 12% per year from the broader market, which is historical Nifty average. Remember, nothing is ever guaranteed. In the first year, you'll get 1.12 lakh rupees, which is decent, and in the fifth year it'll be around 1.75 lakh rupees. It gets interesting, right? And in the 10th year it'll be worth over 3 lakh rupees. Your money has basically tripled, and in 20th year that 1 lakh rupees could explode to over 10 lakh rupees. Now compare that to the FD at 7%. You might get 3.8 lakh rupees in 20 years as against 10 lakh rupees there, and the difference is staggering. Why? Because with compounding, your returns start earning their own returns. It's a snowball effect. The longer your money stays invested, the more powerful it becomes. And it highlights why time in the market is far more crucial than trying to time the market. Okay, with all that said, you're now convinced, and investing isn't optional if you want real growth, right? So where do you put that first 1 lakh rupees? First of all, forget about stock tips, hot IPOs, or that friends, cousins, crypto coin that's definitely going to 10x. For your first investment, the goal must be simplicity, diversification, and scalability. And you need to harness India's growth story. The answer to all that is a simple Nifty 500 index fund. Let's understand why. You almost own the entire market. The Nifty 500 isn't just the top 50 companies of India like the Nifty 50, it's the top 500 companies listed on the NSE. There are large cap companies, small cap companies, and even small caps to a certain extent. And together, they represent over 90% of the investable Indian stock market's value. Think about it, with one investment, you get a diversified slice of entire India's organized economy. It's like ordering a grand thali in a Punjabi restaurant versus one katori of dal in some random restaurant. I don't know if that made sense, but anyways, As a beginner, blindly chasing the highest possible return is a recipe for sleepless nights. You want good returns for the risk you're taking. This is called risk-adjusted returns. Because the Nifty 500 includes mid, small, and large caps, it captures different growth cycles that the Nifty 50 might miss. Data suggests that over many periods, the Nifty 500 has slightly offered better returns and sometimes even slightly lower volatility than narrower indices like Nifty 50, leading to superior risk-adjusted performance. For example, look at the 5-year returns. Nifty 500 is up approximately 140%, while Nifty 50 is up 115% approximately as of today. And more importantly, the diversification across 500 stocks significantly reduces the impact if one or two companies falter. You're not betting on a single horse, you're betting on the entire racetrack. And that's the beauty of simplicity. You make one good decision, pick one good Nifty 500 index fund, done. No need to research hundreds of stocks, track multiple funds, or stress about sectoral calls, right? Crucially, index funds are just passive. They just mirror the index, meaning their costs or their expense ratio are incredibly low compared to actively managed fund. Now, why does this matter? Remember the compounding thing we spoke about earlier? Guess what else compounds? Your expense ratio. So having higher fees compound against you eats away in lakhs over time. A 1% difference in fees can mean 20 to 30% less wealth over 30 years. So choosing a low cost Nifty 500 index fund keeps more of your money working for you. It's efficient, disciplined, and scalable, perfect for building your core portfolio. Yes, there are deeper metrics like the Sharpe ratio that measures this risk reward balance, but the core idea is simple. The Nifty 500 offers a robust, diversified, low cost way to potentially capture India's growth with managed risk. We'll dive deeper into those metrics in future videos, so subscribe to this channel so you don't miss it. Alright, now all the theory is done away with. Let's get practical. How do you actually invest that first 1 lakh rupees? It's actually very simple. Just log into your broking platform. It could be anything like Fires or Zerodha or Grow, basically any broking app that you use. Search for Nifty 500 index funds. You'll see options from reputable asset management companies like HDFC or ICICI or Motilal Oswal, among others. If you're not finding any of these by typing Nifty 500, type this exact ticker MONIFTY 500 and choose how do you go about investing that first lakh, whether lump sum or SIP. In lump sum, you put all of that money at once, a very simple straightforward way to invest. In SIP, you break it down into smaller monthly investments, like for example 10,000 rupees per month for 10 months. This is good for averaging out the market's ups and downs, which is called rupee cost averaging. Or you can honestly go with both, like invest a chunk now, let's say 50,000 rupees now, and you start an SIP with the rest, and you can keep on investing, let's say 5,000 rupees or 10,000 rupees as and when you get your salary credited or your business grows, right? So the fundamental thing to note here is this is a very long-term mindset. This is not a get-rich-quick trade where you make some quick money in 1 month or anything like that. This is for 5, 10, potentially even 20 years, right? Like markets will go up, markets will go down. The thing is to not panic and not sell during the dips, because those dips historically they've been buying opportunities if you look at it that way. If market swings make you anxious, stop checking your portfolio daily. Just set it and automate your future SIPs and focus on your life and focus on your career. So simplicity wins for now. Resist the urge to add 10 different funds immediately. Let this Nifty 500 fund be your core. Once your total portfolio crosses, let's say 10 lakh rupees or 15 lakh rupees, then you can strategically explore adding other funds, but don't complicate things early on. Now, I know what you might be thinking, those little doubts creeping in. Let's tackle them head on. But Vikas, what if I pick the next Infosys or Titan? Yes, you might, or you might even pick the next Yes Bank or DHFL. So you know what has happened with them. If not, just check out the charts and let me know in the comments. Individual stock picking requires deep research, constant monitoring, and carries significantly higher risk. For your first 1 lakh rupees, probability favors diversification. Get the core right first, then maybe allocate a small portion to calculated stock bets later if you develop the skill. You might have another question, but small caps and mid caps give higher returns, right? Yeah, true sometimes, but they also come with a lot of volatility. A 30%, 40% in a small cap fund can happen swiftly. And if you're new, that can trigger panic. The Nifty 500 gives you exposure to mid and small caps as well, but balanced by the relatively stable large caps. It's a smoother ride psychologically and it's easier to stick with. And now you might be thinking, what if the market crashes tomorrow? It might, but nobody can time that. And you're spread across 500 companies. The crash impact is diluted. You're investing for decades and not days. Historically, markets always recover and hit new highs. It takes patience. And honestly, this is why I've been very vocal about having an emergency fund built. It could be in your FT, because this emergency fund acts as your shield. It protects your daily life, meaning you never have to sell during a downturn just to pay bills. And that's the key to surviving crashes and benefiting from the recovery of it. So there you have it, the clear strategic action plan for your first 1 lakh rupees, but only after your foundation is secure. And tell me in the comments what's holding you back from investing that first 1 lakh rupees, or if you have started, what was your first step? Let's discuss, right? And one last time, if that foundation isn't solid yet, please watch the video. I'll link it somewhere here, and get your defenses strong before you attack. Thank you for watching. Keep it simple, keep it smart, give your money the permission and the strategy to truly work for you. See you next time.